Every trader hits a moment where the market feels alive. Prices jump the exact second you freeze, flip the instant you act, and wipe out your stops just before racing off. It's not random, it's too precise, too clever. And deep down, a tiny voice asks the question you've been ignoring. What if the market isn't reacting to charts, but reacting to you? That question is where the real game begins. There is something most traders never learn until it's already too late. You spend months believing the market is random, convincing yourself that losing streaks are nothing more than bad luck, and assuming every sharp wick, sudden reversal, and aggressive stop hunt is just part of normal volatility. But what if none of that is true? What if the force moving against you is not chaos, not chance, not misfortune, but something deeply intelligent and strategically designed to influence the way you think, act, and react? What if you are not trading against the market, but against a psychology far more experienced than yours? That force is smart money, not a single person, not a room of masterminds pressing buttons. It is a collective mindset shared by institutions, hedge funds, algorithmic systems, market makers, and elite professionals, built on one unified goal: exploiting human behavior, not just liquidity, not just support and resistance levels, not just price inefficiencies. It is your behavior they focus on. Because smart money doesn't simply trade price. They trade fear. They trade impatience. They trade overconfidence. They trade the illusions your mind creates under pressure. And the most unsettling part is this: almost everything they do looks accidental until you realize you were the target all along. The truth that most traders never accept is brutally simple. Markets don't move to hurt you. They move because you consistently respond exactly how smart money expects you to. The difference between retail traders and smart money has nothing to do with magic tools, secret indicators, or hidden strategies. The real separation is psychological. Smart money understands patience better than you. They wait when you rush. They attack when you hesitate. They accumulate when you panic. They distribute when you feel safe. They trap you precisely when you believe you finally understand the market. Their entire game revolves around reading the herd, not the chart. And to grasp how deeply this control runs, you must let go of the comforting idea that you are unpredictable, sharp, or different. You are not. You react the same way millions before you reacted because you are human, and humans under pressure are predictable. When price rises, you chase it. When price falls, you run from it. When price pauses, you grow impatient. When price fakes out, you panic. When price trends smoothly, you can't stop yourself from jumping in late. These reactions feel personal, but they are patterns smart money has documented for decades. Your fear is not unique. Your greed is not new. Your frustration, your excitement, your hesitation, none of it is original. It has all been repeated by millions of traders in the exact same conditions. That is why smart money understands you so well. They do not need to see your account. They do not need to watch your screen. They already know what you are likely to do because they have seen the same behavior across countless retail traders around the world. And this is where the deeper psychological trap begins. Smart money doesn't need to manipulate price violently. They only need to guide it toward the points where retail emotion becomes predictable. That is why your stop losses get hunted with surgical precision. Not because the market hates you, but because that exact level is where the majority of traders give up. That is why price reverses exactly where you enter. Not because your timing is cursed, but because the herd always enters at the same emotional moment. That is why you chase breakouts even after promising yourself you wouldn't. Not because you lack discipline, but because the market is designed to trigger your natural impulses. That is why your strategy changes every month. Not because you're confused, but because chaos forces you into searching for certainty. That is why your winning streaks collapse right when you feel confident. Not because of sabotage, but because confidence makes you predictable. That is why the market feels personal, even though it isn't. It reacts to your psychology, not your identity. Everything smart money does is built on one concept: emotional extraction. They don't need to beat you with larger accounts or advanced tools. They only need you to repeat the same emotional mistakes every other retail trader makes. This is why learning more indicators never saves traders. This is why copying strategies doesn't fix your results. This is why watching hours of chart breakdowns doesn't stop the emotional cycle. Because the real problem isn't the chart. It is the psychological patterns smart money counts on you repeating, and until those patterns break, nothing changes. This roadmap is not about teaching setups or secret methods. It is about reconstructing the mindset that smart money relentlessly targets. Because once you understand the true game being played, once you finally grasp what smart money is actually exploiting, You stop becoming the hunted and start stepping into control. The shift happens the moment you stop reacting like retail and start thinking like the force that has been manipulating retail psychology for decades. And once that shift begins, everything about the market starts to make sense. The traps look obvious. The reversals make sense. The stop hunts appear predictable. The patterns you once thought were random reveal intention. Understanding smart money is not about learning how they trade. It is about learning how they think. And the deeper you go, the more you realize you were never trading against price. You were trading against yourself. Before you ever click buy or sell, long before your order reaches the market, smart money already knows how you think. They know the exact moments your confidence rises, the exact situations where your discipline cracks, and the psychological pressure points that shape every decision you make. What traders call strategy, smart money calls behavior. And behavior, unlike price, is predictable. Think about the last time price approached a level you waited on for hours. Your pulse changed, your breathing tightened, your expectation rose. These reactions didn't appear because of the chart. They appeared because you already created a story in your mind about what should happen next. Smart money doesn't need to see your chart to exploit that story. They know that when price moves closer to a key zone, the average trader becomes emotionally attached to their plan. You want to be right. You want the setup to play out. You want confirmation that your patience wasn't wasted. That wanting is the moment smart money begins reading you. They know where you will buy, where you will fear, where you will lose control, where you will place your stop, where you will take profits too early, and where you will FOMO into a terrible entry. Because to them, you are not random. You are a psychological pattern they have seen millions of times. Retail traders across the world behave almost identically because they share the same emotional structure. You believe you're making independent choices, but your decisions follow the same predictable loops driven by fear, hope, impatience, and the constant desire for clarity. Smart money tracks these loops like a roadmap. You chase strength because you fear missing out. You avoid boring markets because they feel like wasted time. You fear losses far more than you desire gains, so you cut profits early but hold losing trades, hoping they turn around. You think in signals instead of probabilities, reacting to candle patterns and chart shapes that trigger emotional impulses. While you see entries, setups, breakouts, and indicators, smart money sees your emotional fingerprints. Every spike, every slowdown, every consolidation is designed to press on those fingerprints. And the deeper you look into how they use these cues, the clearer their game becomes. Smart money uses 4 primary mental triggers to read and influence your decisions. The first is the impulse trigger. When you see a sudden aggressive candle, your brain signals urgency. You assume momentum has started, and if you don't jump in, you will miss the move. Smart money creates these fast spikes intentionally because they know this is the exact moment your fear of missing out overrides your logic. You don't wait for confirmation. You don't check your levels. You enter because you felt pressure. That pressure is the entry point smart money predicted. The second is the relief trigger. After a fake breakout fails, price returns inside the range and your emotional system calms down. You believe the danger is gone. You feel safe. You think the market reset. But this is often the moment smart money quietly builds their positions because they know retail traders relax too quickly after volatility. Your relief creates the blind spot they need. The third is the pain trigger. Contrary to what most traders expect, smart money rarely drives price violently against you. Fast losses shock you, but slow losses torture you. Slow losses make you question your stop. Slow losses force you into second guessing. Slow losses drain your emotional capital long before they drain your actual balance. Smart money uses this gradual pressure to shape your psychological exhaustion. By the time your stop is hit, the real damage isn't the money lost, it's the confidence lost. That loss of confidence affects your next trade, and the next one, and the one after that. The fourth is the reward trigger. You see a large bullish or bearish candle and instantly visualize profit. Your mind imagines the trade succeeding before you even enter it. That emotional projection is predictable, and smart money designs these reward candles to make you commit, even if the overall structure is against you. They make you believe the move has begun when, in reality, it is a psychological setup to capture your liquidity. These triggers reveal the real truth: smart money is not trading price. They are trading on your reactions to the price. They study what you think during consolidation, what you feel during volatility, what you fear during pullbacks, and what you imagine during strong moves. Every candle that forms is a message designed to influence your next choice. They know when you become hopeful. They know when you become scared. They know when you become greedy. They know when you become confident. And they know how to use each emotion against you. This is why so many traders believe the market is watching them personally. It feels personal because it feels so precise. You enter, price reverses. You close, price moves without you. You change your stop, price hits the new one. You quit for the day, the setup appears. This is not a coincidence. It is engineered predictability. When millions of traders think the same way, feel the same emotions, and act at the same levels, smart money doesn't need your individual information. They only need probability. They only need patterns. They only need the psychology that has been repeated since the beginning of trading. The most dangerous illusion is thinking you are the exception. That illusion blinds you. Smart money removes that illusion by showing you exactly how predictable you are. They place the price near your levels, knowing you will react. They consolidate long enough to break your patience, knowing you will act out of frustration. They show strength to trigger your chasing instincts. They show weakness to trigger your fear. They slow the market to increase emotional pressure. They speed the market to increase emotional urgency. And through all of this, they see your decision before you make it. Not because they see your screen, but because they understand your mind. Their entire advantage rests on this understanding, and your entire transformation begins the moment you realize that they don't need to outsmart you. They only need to let your psychology work against you. The next level of control is even deeper. Your stop loss is not a protective tool. It is a psychological footprint, a broadcasted signal of your fear, your emotional threshold, your breaking point, and smart money relies on that more than you realize. Every time you place a stop loss, you reveal exactly where your belief ends and where your panic begins, and this is why your stop becomes smart money's most efficient entry point. When you enter a trade, you think the market is reacting to price levels, but smart money is reacting to the weakness behind those levels. Your stop is where you admit defeat, and smart money thrives on predictable defeat. They know that retail traders almost always put stops at obvious, logical, clean locations because humans crave structure, safety, and clarity. And smart money weaponizes this need for clarity by turning your structure into their liquidity. They don't hunt your stop out of malice. They do it because your stop is liquidity, and liquidity is opportunity. They need your exit to fuel their entry, and your loss becomes the energy source for their next impulsive move. That is the truth most traders never internalize. Smart money doesn't enter at random places. They enter where fear clusters. Your fear. Everyone's fear. The collective psychological breakdown of retail traders creates pockets of guaranteed liquidity, and smart money uses these pockets like precision strike zones. First, they build your confidence because confident traders reveal their stops without hesitation. A strong breakout, a clean trendline tap, a perfect order block, they know exactly what makes retail traders excited. Once you see a big candle move in your direction, the feeling of, finally, this is my moment, makes you forget caution. You enter, you place a stop. You feel in control. But what you don't realize is that smart money didn't push price in your direction to reward you. They pushed it just far enough to gather your interest, ignite your expectation, and create a cluster of stop losses below the structure you just trusted. Now you feel safe, but your safety is the illusion they engineered to create the liquidity pool they need. Then comes the second move, the precision drop into the herd stop zone. The market doesn't reverse sharply. Sometimes it slowly crawls downward to increase psychological discomfort. Slow losses feel more personal, more manipulative, more unfair, and that emotional pressure makes your eventual stop out feel like a betrayal. That is intentional. Smart money designed the movement to make you exit, because your forced exit provides the liquidity required for their entry. They don't want your money, they want your volume. Your stop is the fuel that powers their direction. That is why they go through your stop level before continuing the original trend. The trend was not wrong. Your timing was wrong because your psychology was predictable. You exited exactly where they expected you to. Liquidity psychology operates in 3 layers, and each layer represents a different form of vulnerability. First is the herd stop zone, created by traders who think in identical patterns. These are the stops placed at the most obvious levels, below double bottoms, above double tops, under clean swing lows, over clean swing highs. These zones glow like neon signs on institutional charts. Smart money knows there's guaranteed liquidity there because thousands of stops create a cluster of easy volume. When price wicks into these zones, it doesn't happen by accident. It happens because that is where the most predictable retail behavior sits. Next is the emotional stop zone, which is even more powerful. These are not technically placed stops. They are emotionally driven exits. Traders who hold losers too long eventually exit at a point of emotional exhaustion rather than technical invalidation. Smart money knows the emotional pain threshold better than most traders know their own. They design movements to apply slow, grinding pressure until the trader gives up in frustration or fear. When emotional exits occur, liquidity floods into the market in a way that is even more valuable than herd-based stops, because emotional traders exit with desperation, not logic, giving smart money perfect entry fills. The third layer is the structural stop zone, formed around major market structures, highs, lows, significant candles, order blocks, fair value gaps, trendline intersections, and previous imbalances. Retail traders almost always put stops around these structures because they appear safe, but safety is the bait. The clearer the structure, the juicier the liquidity pocket becomes. Smart money repeatedly taps these levels because every tap empties stops and reloads liquidity. The brilliance of smart money does not come from manipulation. It comes from understanding psychological consistency. Retail traders believe they're acting independently, but when you view the market from smart money's perspective, retail behavior looks uniform, predictable, almost mechanical. They know you will move your stop tighter when stressed. They know you will widen your stop when hopeful. They know you will set your stop just beyond the obvious zone because hoot feels right. They know you will close early when you see a small profit because you fear losing it. They know you will hold a losing position because you hope it will turn around. Every behavior becomes a signal. Every signal becomes an opportunity. And every stop loss becomes a pathway for smart money to accumulate without friction. They don't fear your stop. They feed on it. The deeper truth is this: the market does not hunt your stop. Your predictability pushes your stop into the jaws of the market. Smart money does not need to manipulate you. They simply need to understand you. And they do, perfectly. Until you stop thinking like a reactive trader and start thinking like a probability-based operator, the market will continue to use your emotions as entry signals. The game is not personal, it's psychological. And your stop loss is not just a tool, it's a message. A message that smart money reads with absolute clarity. Fakeouts are not accidents, glitches, or market noise. Fakeouts are psychological weapons engineered to expose the most predictable weaknesses in traders. Every time you react emotionally, the market reacts strategically. The purpose of a fake move is not to confuse you randomly, but to guide your emotions toward the exact decisions smart money needs you to make. A fake breakout is designed to make you hopeful. A fake breakdown is designed to make you fearful. A sudden reversal is designed to make you doubt yourself. Each move has a psychological target, and the target is almost always the emotional response of retail traders. Fakeouts work because traders don't trade price, they trade emotion disguised as analysis. When price breaks above resistance, and you feel that rush of excitement, that sense of finally catching the move, that quiet hope that this time it will run, you are not making a calculated decision. You are reacting to a story your mind creates. Smart money knows this pattern so well that they can forecast the emotional wave before it even starts. They know the exact moment a retail trader becomes confident enough to click the buy button, and that is the exact moment they prepare the reversal that welcome in. Fake move preys on a trader's anticipation. You wait for a breakout. You endure consolidation. You watch price squeeze against the level. Tension builds. The moment price finally pops above resistance, you feel relief, certainty, validation. But while you are celebrating the breakout, smart money is using your excitement as liquidity. You enter the perfect breakout, but they enter the perfect exit. And seconds later, when price snaps back under the level, the emotional shift inside you is immediate. Hope turns to confusion, confusion turns to frustration, frustration turns into the painful realization that you were baited, not randomly, precisely, because the goal was never to continue the breakout. The goal was to make you commit before reversing. The second trap, the push you out, fake move, is even more painful because it attacks the emotion every trader hates the most, being right about direction, but wrong about timing. This trap is designed to extract you from winning trades by hitting your stop loss before the real move begins. You enter a strong setup, everything aligns, momentum supports you, structure supports you, logic supports you. For a moment, the market moves in your favor and confidence rises. Then, without warning, price dips just enough to hit your stop loss and immediately reverses. You stare at the chart in disbelief as the market explodes in your original direction without you. The emotional damage is severe because it creates the illusion that the market is specifically targeting you. But the truth is simpler. Smart money wasn't trying to attack you personally. They were collecting liquidity. Your stop loss was part of a giant liquidity pool sitting below the structure. When they pushed price down, they were not invalidating the setup. They were harvesting stops to fill large positions. The market did not hate you, it simply used you. This is psychological extraction at its highest level, make the trader feel wrong even when the idea is right. That emotional confusion ensures the trader hesitates next time, enters late, or avoids the setup entirely. And hesitation is exactly what smart money needs from the retail side. The third trap, the delayed trap, is one of the most overlooked psychological weapons because it doesn't target fear or excitement. It targets boredom. Traders underestimate how dangerous boredom is. When price moves slowly, ranges tightly, and refuses to choose a direction, traders mentally drift. They lose patience, they lose focus, and eventually they lose interest. Smart money knows that retail traders crave movement, action, and confirmation. So they drag price deliberately, sometimes for hours, sometimes for days, until most traders mentally check out. In that moment of boredom-driven neglect, the real move begins. And the trader who once watched the level closely suddenly sees the market running away without them. The emotional hit is deep regret mixed with frustration, and that frustration often leads to FOMO entries at the worst possible moment. The market does not punish late entries because it hates you. It punishes late entries because smart money needs liquidity at the top of the move. Boredom creates emotional blindness. Emotional blindness creates late decisions. Late decisions create liquidity. Liquidity fuels smart money's move. This cycle repeats endlessly because retail psychology repeats endlessly. Fake moves exist for one reason: retail traders react emotionally, and smart money reacts strategically. Retail sees opportunity, smart money sees vulnerability. Retail sees breakout candles, smart money sees a crowd rushing into a trap. Retail sees stop losses as protection, smart money sees them as fuel. Retail sees consolidation as uncertainty, smart money sees it as preparation. Fake moves are not designed to trick traders randomly, they are designed to test emotional thresholds. Every fake move asks a psychological question. How badly do you want this trade to work? How quickly will you panic if price moves against you? How easily do you give up when the market goes quiet? How desperate will you become when you see the move happening without you? The market uses your answers to guide its movement. The truth is that fake outs hurt because they expose something most traders try to hide: impatience, fear, greed, hope, doubt. These emotions are not weaknesses, they are patterns, predictable patterns, and predictable patterns are exploitable. Smart money doesn't need to manipulate price. They simply need to follow the emotional footprints left by traders who cannot control their reactions. Fake outs will always exist because traders will always react the same way. Until you stop responding emotionally and start thinking probabilistically, the market will continue to trick you first and reward you last. The trap is psychological long before it becomes technical. You can understand trend direction perfectly and still lose money because the market doesn't punish your analysis. It punishes your psychology. Trends are not just movements on a chart, they are emotional cycles disguised as price movement. Smart money studies this cycle because it repeats every single time, no matter the asset, time frame, or trader. The painful truth is that most traders enter trends at the exact moment smart money exits, and they exit trends at the very moment smart money enters. Not because retail traders lack skill, but because they misjudge the emotional rhythm inside every trending market. A trend is not defined by candles. It is defined by how traders feel at each stage of the move. Early in the trend, the market whispers, not shouts. Price begins to shift quietly, structure slowly bends, momentum slowly changes, and volume starts creeping in. But emotionally, this stage is filled with doubt. Even when the trend direction is clear, you hesitate because the move feels too early, too unconfirmed, too uncomfortable. And this hesitation is exactly why smart money loves the early trend phase. When the crowd is scared, smart money can accumulate without competition. They know most traders won't enter here because fear is louder than logic. You watch the early trend begin, but instead of entering, you analyze, reanalyze, hesitate, second guess, and wait for confirmation that never comes cheaply. By the time you finally trust the trend, smart money has already built their entire position. The mid-trend phase is where psychology flips. What once felt uncertain now feels obvious. You finally see the trend clearly. You finally believe it. And you finally convince yourself that entering late is safer than entering early. But this is the exact moment smart money begins distributing. They don't close everything at once. Doing so would expose their intentions. Instead, they release positions gradually, letting retail enthusiasm absorb their exits. You think the trend is strengthening, but in reality, the strength is generated by late buyers like you. This is why mid-trend entries often produce small moves or choppy reactions. You are entering during smart money's slow exit. You're not wrong about the trend, you're late about the psychology. What feels safe to you feels profitable to smart money. They rely on your new confidence to distribute without alerting you. Every candle you see as confirmation is a candle they see as liquidity. By the time the trend reaches its famous, confident phase, the emotional trap is complete. Trend exhaustion is the most dangerous psychological stage because it feels like the moment of greatest clarity. Price moves smoothly. Momentum is stable. Pullbacks are shallow. Traders cheer online. Social media becomes bullish or bearish in unison. This is where your confidence peaks because you feel like the trend cannot stop. You stop thinking in probabilities and start thinking in absolutes. You hold longer, you enter more aggressively, and you believe you are following the strength. But smart money sees the opposite. They are not watching the candles, they are watching the emotional shift. When confidence becomes certainty, they know the trend has reached its maximum crowd participation. A trend dies the moment the crowd believes it is unstoppable. This is when smart money unloads aggressively. They don't just exit, they reverse. They use the crowd's confidence to offload massive positions at premium prices. You see continuation, they see exhaustion. Your conviction is their exit signal. Then comes the trend reversal, the emotional phase built around shock. Price turns sharply, faster than you expect, harder than you can emotionally handle. At first you ignore it. You tell yourself it's a pullback. You tell yourself the trend is still strong. This denial is the psychological anchor that smart money counts on. They know traders will hold losing trades longer in a trend because they believe the larger structure will save them. But the reversal becomes stronger, and each drop feels more personal. When you should exit, you freeze. When you should cut your loss, you hope. When you should accept the trend has changed, you wait for signals that never come. Smart money uses this paralysis as liquidity. As the trend collapses, your loss becomes their fuel. Every trader holding a losing position becomes a liquidity source for smart money's new direction. That shock you feel during a reversal is not random. It's engineered by the emotional imbalance created during the previous trend phase. The market uses your confidence against you because confidence blinds you from seeing the shift. The real reason traders misread trends is not because they misunderstand structure, but because they misunderstand themselves. Every trend exposes emotional patterns, the hesitation at the beginning, the excitement in the middle, the confidence near the top, the denial during the reversal. Traders repeat these behaviors because they feel natural. They match human instinct. But smart money is not driven by instinct. They are driven by data, probability, and psychological observation. They understand that traders struggle with early entries because early entries require courage. They understand that traders enter mid-trend because mid-trend feels safe. They understand that traders become greedy near trend exhaustion because confidence clouds judgment. They understand that traders freeze during reversals because losses activate fear more strongly than logic. Smart money does not need to predict the market. They only need to predict how traders react to the market. And those reactions follow the same script in every trend cycle. Being right about the trend is easy. Being aligned with the psychology of the trend is rare. That is why you can predict the direction correctly and still lose. You are reacting to emotional signals, not technical ones. You wait for comfort instead of confirmation. You trust your feelings instead of structure. You trade the trend you feel instead of the trend that exists. And smart money exploits this gap between emotion and reality. Trends don't destroy traders. Emotional timing does. Until you understand the psychological sequence inside every trend, you will continue entering when smart money exits and exiting when smart money enters. The market doesn't punish bad traders, it punishes emotionally predictable ones. Time is the most underestimated weapon in the entire market, and smart money uses it with more precision than any price pattern you've ever studied. Traders fear losses, but they fear waiting even more. The market knows this. Smart money knows this. And this is exactly why time becomes the quiet battlefield where most traders lose long before price even moves. You think you struggle with entries or exits, but your real weakness appears in the empty spaces, those long, slow, silent periods where nothing seems to happen. In those moments, your patience is tested, your discipline is stretched, and your mind becomes louder than the chart. Smart money doesn't need volatility to trap you, they simply need time. They understand that most traders won't sit and wait for quality. They understand that boredom is more dangerous than volatility. They understand that a long consolidation will break your mental state faster than a sharp loss. And so, they manipulate the clock as much as they manipulate the candles. When the market enters a long consolidation, something begins to shift inside you. The first few minutes feel normal. Then the hesitation starts. then the tension, then the impatience. You stare at the chart waiting for direction, hoping for a breakout, wanting movement, craving confirmation. But the consolidation stretches longer than you expect. You start thinking the market is dead. You start questioning whether you should move to another pair, another setup, another time frame. This is where the time trap begins to tighten. While you grow restless, smart money quietly collects liquidity. They use the silence to build positions without drawing attention. They want you impatient, bored, and distracted because boredom forces bad decisions. When nothing happens, you create your own action. You force trades that never should have been taken. You convince yourself that something is better than nothing. This is how time becomes an emotional trap, because your mind cannot accept stillness without feeling the need to intervene. Smart money knows this. They rely on it. They let you bleed patience long before they make you bleed money. Then comes the slow movement phase, the most manipulative time-based tactic used by smart money. It's not fast enough to scare you, not strong enough to excite you, just steady enough to make you uncomfortable. When price moves slowly against your position, you experience a unique psychological pain. Fast losses create shock, slow losses create self-doubt, and smart money prefers doubt because doubt makes you exit early. They push price just enough to test you, just enough to make you question your entry, just enough to make you close the position before the real move begins. You think you're being responsible, you think you're managing risk, but you're not. You're being controlled by the pace of the market. The slowness is designed to drain your emotional stamina. Smart money needs you to close early so they can build size without opposition. And you give them exactly what they want because the movement is uncomfortable but not frightening, annoying but not alarming. Slow movement is not meant to take your money. It is meant to take your conviction. Once conviction breaks, smart money owns your trade. Eventually, the delayed breakout arrives, the final phase of the time trap. This is where impatience finally punishes you. After enduring long consolidation and slow movement, you mentally check out. You stop monitoring. You stop caring. You stop believing the move will ever come. You lose interest. And that loss of interest is exactly what smart money waits for. They don't want you inside the move when the explosion happens. They want you outside watching, helplessly, as price shoots away without you. The moment you look away is the moment the market chooses to move. This delay is not coincidence, it is precision. Smart money waits until the maximum number of traders have stopped paying attention before releasing the real trend. They want the crowd late, emotional, and reactive. They want you chasing the breakout instead of catching it. And when you finally FOMO back in, exhausted by waiting and desperate to participate, the move slows or reverses because smart money has already taken the premium exits. You are not punished because you lacked skill. You are punished because you lacked patience. The real weapon smart money uses is not manipulation of price. It is manipulation of your perception of time. They know that every trader has an emotional threshold for boredom. They know how long it takes for frustration to set in. They know how long you can hold a trade before you start doubting it. They know how long you can watch consolidation before you start forcing entries. Time reveals emotional weakness more accurately than price ever will. You think you are being disciplined by watching the chart for hours, but you aren't watching. You are waiting, and waiting is where discipline dies for most traders. Your mind fills the silence with assumptions. Your emotions fill the silence with impatience. Your focus dissolves the longer nothing happens. And that psychological erosion is exactly why the time trap works so flawlessly. The truth is that most losses in trading do not come from bad setups. They come from not waiting long enough for good setups. Patience is not optional, it is structural. It determines your timing, your execution, your clarity, and your emotional state. Smart money uses time to create an environment where you destroy these qualities yourself. They don't have to force mistakes, they simply wait for you to make them. Every forced trade, every early exit, every late entry, every chase, all of it is a reaction to time pressure. The market doesn't rush you, you rush yourself. Smart money simply benefits from that rush. Until you learn how to endure stillness, you will always find yourself on the wrong side of the move. Time will always defeat those who cannot control their emotions, and smart money will always dominate those who cannot control their time. Emotional manipulation. The breakthrough moment smart money waits for smart money isn't focused on the candlesticks you obsess over. They're focused on the invisible battle happening inside you. The psychological pressure-building trade after trade until your judgment cracks. They don't need you to lose money through bad analysis. They need you to lose control of yourself. That's the moment they wait for. The moment you shift from calculated decision making to emotional impulse. The moment your internal state becomes predictable, exploitable, and profitable for them. Every trader reaches three emotional states where they become blind, reactive, and perfectly aligned with smart money's liquidity needs. The overconfidence phase is the first trap, and it's one of the most dangerous because it disguises itself as success. You win a few trades, you feel sharp, you feel aligned with the market. You convince yourself you finally understand the movement. You start believing the illusion of mastery. Confidence becomes certainty. Certainty becomes ego. Ego becomes blindness. And the moment you start sizing up because you think you're in rhythm is the moment smart money strikes. They allow you to feel comfortable. They allow you to feel skilled. They allow you to feel untouchable. Then they pull liquidity, shift volatility, widen spreads, or trigger false breaks. Not to destroy your strategy, but to test your emotional discipline. Because when a trader becomes overconfident, they stop following rules. They stop being patient. They stop being objective. They become predictable. Smart money isn't attacking your entry. They're attacking your belief that you can't lose. Once that belief breaks, the second stage begins, the fear spiral. This is the phase where the trader becomes fragile. You take a loss. Another one follows. Your confidence gets shaken. You hesitate at every signal. You second-guess every setup. You enter late. You exit early. You break rules to avoid pain. You break rules to avoid risk. You break rules because you don't trust yourself anymore. Smart money thrives in this exact emotional environment because fear provides the perfect fuel for major institutional moves. Your hesitation becomes their entry. Your stop becomes their liquidity pool. Your doubt becomes their confirmation. Your shrinking size becomes their advantage. A fearful trader behaves like a trapped animal, reactive, defensive, and incapable of rational decision-making. You start avoiding good trades and taking safe but pointless ones. You start thinking in terms of danger instead of opportunity. Smart money knows fear has a predictable pattern: smaller positions, tighter stops, early exits, premature panic, emotional paralysis. They don't need to manipulate price, they only need to manipulate your reaction to it. And once fear fully consumes you, the emotional pendulum swings to its most destructive opposite, the revenge trade meltdown. This is the point where the trader is no longer thinking about the market, they're thinking about themselves. They're thinking about lost money, lost confidence, lost control. You stop seeing the chart as data and start seeing it as an enemy. You want the market to give back what it took. You want to reverse the pain. You want to feel equal again. That desire is the exact opening smart money counts on. Because revenge trading is liquidity on fire. You enter too fast. Your size is too big. You ignore structure. You chase candles. You abandon risk management. You abandon analysis. You abandon everything you know in exchange for emotional relief. Smart money doesn't need to force anything here. You self-destruct for them. The meltdown is predictable: one oversized trade, then another, then the account destruction you swore you would never repeat. Smart money profits, not because they outsmart your strategy, but because they outlasted your emotional stability. The breakthrough moment isn't when you gain more knowledge. It isn't when you learn a new pattern. It isn't when you backtest another setup. The real breakthrough happens when you understand this truth. Smart money is not controlling prices as much as it is controlling your internal state. Your emotions are the true liquidity. Your reactions are the true vulnerability. Your impulses are the true entry signals for them. They wait for your overconfidence because confident traders take reckless risks. They wait for your fear because fearful traders hand over liquidity. They wait for your revenge because angry traders open the floodgates of self-destruction. The entire game is built around your emotional cycles, not your technical skills. The market rewards the trader who can feel emotion without acting on it. The trader who can win without becoming euphoric. The trader who can lose without becoming afraid. The trader who can think when others panic and wait when others chase. Smart money thrives on traders who react. Smart money suffers against traders who observe. The moment you stop giving your emotions to the market is the moment smart money loses its greatest advantage. And the moment you realize that mastering your internal state is more important than mastering your strategy is the moment you finally separate yourself from the retail crowd. The breakthrough is not skill, it is emotional neutrality. That is the state smart money cannot exploit. Escaping the trap. How you think like smart money is not stronger than you, richer than you, or smarter than you. Their advantage comes from one simple truth. They understand the psychological weaknesses that retail traders refuse to confront. They know how you react when you're excited, scared, frustrated, impatient, or desperate. They know how your mind creates traps long before your strategy ever does. And because they understand how you think, they can predict your behavior with terrifying accuracy. The real breakthrough begins when you stop trying to beat smart money at their own game and start thinking the way they do. The escape is not in more indicators, more secret strategies, more backtests, or more screen time. The escape comes from reversing the psychological rules that keep you stuck in the retail loop. The first shift is simply smart money trades less and observes more. They are not chasing setups, forcing entries, or staring at the chart while hoping for something to happen. They let the market reveal its intention. They wait for the story to form. They wait for emotional extremes to build. Retail traders jump at every candle. Smart money waits for clarity. When you stop needing to trade and start needing to understand, you instantly remove yourself from the retail category. The second rule: wait for liquidity. Don't become it. Retail traders place stops where everyone places them. Smart money knows exactly where those clusters sit. The goal is not to hide from the market. It's to stop offering the market free liquidity. Your stops must be placed behind structure, not behind emotion. If your stop feels safe, it's probably visible. If it feels uncomfortable, it's probably invisible. Smart money hunts confidence, not logic. The third rule: follow structure, not emotions. Structure shows you where the market is building intention, gathering orders, shifting direction, or preparing an imbalance. Emotions show you where retail traders are panicking, chasing, hesitating, or hoping. Smart money reads structure because structure doesn't lie. Retail reads emotions because emotions feel urgent. When you follow the chart's logic instead of your mind's noise, you step into smart money territory. The fourth rule: don't chase breakout candles. Breakouts are designed to trigger emotional reactions. If you feel excitement, adrenaline, or the urge to catch the move, you're already late. Smart money enters where excitement doesn't exist. They enter where boredom exists. They enter before emotion. The fifth rule: enter where others exit. Every painful point on the chart represents opportunity. Trapped buyers, trapped sellers, stop hunts, panic exits, and premature break-even closures. These are the exact moments smart money positions itself. Retail sees pain as danger. Smart money sees pain as liquidity. If you enter where others feel discomfort, you start aligning with the real flows behind the chart. The sixth rule: stop predicting. Start reacting logically. Predictions are for emotional traders. Logic is for smart money thinkers. Smart money does not try to guess the future. They react to imbalance, structure breaks, inefficiencies, and liquidity shifts. They don't need to be right. They need to respond correctly. Retail traders decide a direction first and look for confirmation later. Smart money waits for the market to show its hand. The seventh rule: let trends come to you. Chasing is a retail disease. If the market is trending, it will give you a controlled pullback, a re-entry zone, a discount, or a premium level. If the market doesn't offer a clean opportunity, smart money waits. Trends become easier when you stop running after them and start letting them form around proper structure. The eighth rule: never trade boredom or frustration. These are the two emotional states where retail traders lose the most. Boredom pushes you to force trades. Frustration pushes you to take revenge trades. Smart money only trades clarity. They trade when the market is giving something, not when the trader is demanding something. If your emotions are loud, the market becomes quiet. If your emotions are quiet, the market becomes clear. The ninth rule: take profits with discipline. Smart money doesn't fall in love with a candle. They don't wait for the perfect exit or dream of catching the entire move. They exit before greed blinds them. They exit before excitement takes over. They exit while retail enters. A controlled exit is a psychological edge. Retail traders lose because they treat profits emotionally instead of strategically. The 10th rule: lose like a professional. Smart money accepts losses as operational costs. They don't panic. They don't react emotionally. They don't throw their plan away. A small controlled loss keeps your mind sharp. A large emotional loss destroys your entire identity. Smart money protects mental capital the same way they protect financial capital. When you start following these rules, the entire chart changes. Fake-outs stop looking like manipulation and start looking like opportunities. Stop hunts stop looking like attacks and start looking like discounted entries. Consolidation stops looking like boredom and starts looking like accumulation or distribution. Reversals stop looking random and start looking predictable. Trends stop looking confusing and start looking structured. Your mind stops being your enemy and becomes your advantage. The shift is not mystical. It is psychological. Smart money doesn't win because they're unbeatable. They win because retail traders enter the market with an emotional mind. When you flip the psychology, you flip the game. When you think like smart money, the traps disappear. The confusion disappears. The fear disappears. The need to guess disappears. And once the psychology changes, your entire trading career changes with it.